You guys know by now that we really try to be good stewards to the industry. We avoid dumping on names where we can because it's a lot easier to be a critic than it is to be a builder. But these lithium guys, man, they make it really dang hard sometimes. And the latest economic study released by Surge Battery Metals is no exception to that statement. Don't miss the Rural Symposium for Natural Resource Investing happening July 7th in Boca Raton. If you can't make it in person, that's not a problem. You can get your ticket to watch live online or on demand. We'll be there with the deep dive, so if you make it out to Boca, come say hi at our booth. If you want to sign up, click on the link in the description to get your pass. Let's dive in. Surge Battery Metals has released a preliminary economic assessment for their Nevada North Lithium project, which is found in the far northeastern corner of Nevada. The study builds upon an initial resource estimate and subsequent update that was issued in 2024. That estimate suggests that the lithium deposit here amounts to a pit-constrained inferred resource of 11.2 million tons of lithium carbonate equivalent, with average grades of 3,010 ppm at a 1250 ppm cutoff. But a portion of that deposit, 2.6 million tons of LCE, is located on lands that are majority owned by the ASX-listed Evolution Mining, which leaves Surge with an attributable resource of 8.7 million tons. The estimate is based on just 28 drill holes that were drilled between 2022 and 2024 for a combined 4,000 meters, which is quite small. But to be fair here, the lithium is hosted within multiple laterally extensive clay beds, with a total of 7 lithium-rich horizons identified. But widths range in thickness from over 50 meters to just 2.5, with an average width of 15 meters. Basically, this is a long way of saying that there's a reason the current resource is in the inferred category, because there's a lot of variability here. But the GEO is confident enough that these resources are there. Anyways, this is what the preliminary economic assessment released earlier this month is built upon. And despite this rather small-scale exploration, the comparisons are already being made to Thacker Pass in a big way. With that being said, let's look at this PEA. All right, so it appears that Surge intends to be in the lithium business for a long time here, with their current economic model based on an operation that would boast an initial life of mine of a whopping 42 years. The economics outlined are what Surge refers to as a low-cost, large-scale, and long-life conventional open pit and dry stack tailings operation. In an effort to get some cash flow generated, the project has been designed in 2 phases, with phase 1 getting the processing capacity to 2.6 million tons per annum, while the second phase of operations, which is to come online in year 4 of production, will double that capacity to 5.2 million tons per annum. Under this model, production is expected to peak in year 6 at 109,000 tons of lithium carbonate equivalent, while production over the life of mine is a bit lower at 86,000 tons of LCE per year. Over that 42-year mine life, it translates to about 3.6 million tons of LCE being produced at a recovery rate of 82.8%, which isn't even half of the total inferred resource that is attributable to Surge. With an expected strip ratio of 1.6, a total of 205 million tons of mineralized material is expected to be mined from the open pit, at average grades of 4,016 ppm lithium. 14 phases of pit mining are expected over the 42-year life of mine, which includes just 3 months of pre-production mining. In terms of processing, the intent is to produce battery-grade lithium carbonate. This will be done by processing the mined material with a sulfuric acid leaching process to produce a high-purity lithium carbonate, which will then be upgraded to battery-grade via further refining. The production of battery-grade lithium carbonate, however, comes at a cost. Initial capital costs here are estimated at a very expensive $3 billion, and that's just for phase 1, of which $23 million is attributable to the mine and the remainder to the processing plant and infrastructure. Phase 2, meanwhile, adds a further $2.3 billion to the capex figure, bringing total capex to $5.3 billion. Well, over the life of mine, sustaining capital is estimated at $1.5 billion, of which again just $142 million is related to the mine. The entire cost here is largely related to the processing plant that is required to produce a product that the industry actually wants. On a per ton basis of LCE, total costing is estimated at $5,100, of which $4,300 per ton is related to just lithium processing. But gross revenue over those 42 years is estimated at $87 billion, leading to an after-tax net present value of $9.2 billion and an IRR of 22.8% with a payback period of 4.7 years using an 8% discount rate. Average annual cash flow is pegged at $1 billion, while cumulative cash flow on an undiscounted basis is estimated at $51 billion. At least that's what Surge is saying. But this is where the gripe is. The estimate is based on $24,000 a ton LCE, which is, no joke, more than 3 times the current price of lithium carbonate. Current investors will say that it's simply Surge enabling easy comparisons to the nearby Thacker Pass project, which we'll get into in a minute, alongside the pricing being based on long-term lithium pricing, which is questionable to put it politely. Not to mention that Surge's own investor deck states that current pricing is under pressure due to short-term oversupply, which is before Thacker Pass even comes online. But the sensitivity tables on the very lowest end only go as low as an LCE price of $15,000 a ton, which drops the NPV from $9.2 billion to $2.8, while the IRR drops from 22.8% to 13%. And that's still at a lithium price that is more than double current pricing. So take it as you will. We know we'd be roasted by our viewers if we didn't do it, so let's make a quick comparison to the Thacker Pass project here, which is found a few hundred kilometers due west from Nevada North. We're going to keep it simple here because we're comparing a feasibility study to a preliminary economic assessment, which is a bit silly on the face of it. Anyways, Lithium Americas has gone about things a bit different here, and they have 2 models. First is the design summary, which sees Thacker Pass operating over an 85-year mine life at a production rate of 160,000 tons per year over a 5-phase expansion plan. And then there's the economic model, which envisions a 25-year mine life. That economic model is based on 160,000 tons per year of LCE production with total capex of $12.3 billion, which is obviously more than double Surge's expected capex. But phase 1 and 2, which will get the mine to 80,000 tons per annum of production, totals out to $5.26 billion, which is slightly cheaper than Surge. Sustaining capital is pegged at $1.55 billion versus Surge at $1.5 billion, although the former is for 25 years while the latter is for 42. Operating costs on average are estimated at $6,200 per ton of LCE for Thacker Pass versus $5,100 for Surge. And in terms of NPV, Thacker Pass is estimated to have a net present value of $5.9 billion and an after-tax IRR of 19.6% versus $9.2 billion and an IRR of 22.8% for Nevada North. Both those NPVs used an LCE price of $24,000 a ton and a discount rate of 8%. But Thacker Pass's numbers are obviously muted due to the shorter mine life and a capex of more than double, because it costs a lot more to get production to 160,000 tons a year than it does to get things to 80,000 tons a year, and there was less time to recover those costs. So it's kind of a wash. The big difference here, obviously, is that one has the backing of one of the big 3 automakers, while the other does not. Not to mention, one is a feasibility study and the other is a PEA, and the variability that both those studies imply. All right, so let's wrap it up. Surge headlined a big number with their news release, a real big number, but that number is only achievable in what is effectively the dream scenario. Well, you can argue that it was done to compare things to a nearby peer. The reality is that the argument doesn't hold a lot of weight. The purpose of an economic study is to determine whether or not an operation would be economic, and whether it's worth the effort of sourcing financing and building a mine to generate that income. Conducting a study at 3 times the prevailing price of a mineral is rather pointless in our view, especially when the sensitivity tables don't even come close to recognizing the economics at current pricing. Surge has a large following of retail investors that care about the story, and I tip my hat to them for establishing those sticky followers. And we'll probably see some of them downvote this video because of our stance on the PEA. But sometimes you have to call things like you see them. All right, everybody, thanks for watching. If there's stories you want us to cover, as always, let us know in the comments section. We got lots of coverage over on our channel, which you got to check out if you're into mining equity analysis, or over on our website, TheDeepDive.ca. If you haven't already, do me a favor, smash that like button, subscribe, ring that notification bell. All right, everybody, thanks for watching.